All right, let's jump right in. Have you ever wondered how the massive, systematic funds actually bridge the gap between incredibly dense stochastic calculus and real-world friction-heavy portfolio execution? Well, that's exactly what we're tackling in this explainer today. We're going to pull apart the complex mathematics behind trend-following systems so we can see how these models actually work under the hood.
Here is our roadmap for today. We'll start with the trend-following ecosystem, then look at the three flavors of trend, dig into the mathematical engine, stress test those models, and finally, wrap up with real-world market application.
Starting off with Section 1, the trend-following ecosystem. To put the sheer scale of this industry into perspective, commodity trading advisors, or CTAs, manage a staggering $340 billion in assets as of late 2024. And, that doesn't even count the massive allocations running through quantitative investment strategies at major investment banks. Make no mistake, these quantitative, systematic strategies are an absolutely dominant force in modern finance, and they are moving markets every single day.
But this isn't some flash-in-the-pan new phenomenon either. This industry actually traces all the way back to the legendary turtle traders taught by Richard Dennis back in the early 1980s. And the academic validation goes back just as far. John Lintner, in 1983, provided the first hard evidence that managed futures offer incredible diversification benefits for traditional long-only portfolios.
Moving on to Section 2, three flavors of trend.
When you look at the landscape of trend following today, it really boils down to three distinct philosophies: the European trend-following system, the American trend-following system, and time series momentum, commonly called TSOM. Now think of these not as entirely different animals, but more like different sets of tools being used to hunt the exact same underlying market alpha.
The biggest philosophical divide here, it's definitely between the European and American systems. The European system is incredibly fluid. It uses continuous weights based on moving averages, so it's constantly resizing its positions based on signal strength. On the flip side, the American system, which was actually born from those original turtle traders, is highly discrete and binary. It relies on strict breakout channels and hard stop-loss levels. Essentially, you are either in the trade or you are out.
For our deep dive today, we are going to focus heavily on the European system. Why? Because its continuous mathematical nature allows for exact, closed-form analytical solutions, which is perfect for an explainer like this. And the absolute heartbeat of this system is the EWMA filter, the exponentially weighted moving average. It weights recent price data more heavily than older data. Think of the span of this filter exactly like a radio dial, letting you tune into completely different frequencies of market signals.
Now let's look at how this actually plays out visually. This chart maps the filter's reaction over time to a single market shock, a unit impulse of 1 at time t equals 1. See that blue line? That's a single fast filter with a 50-day span. It spikes instantly, right? But then it decays super quickly. Now compare that to the green line, which is a slow 250-day span. It barely even registers the initial shock, but it holds onto that memory for hundreds of periods. And this brilliantly sets up the red line, which is a long short filter, literally just the difference between the two. Notice how it starts at 0, peaks around day 40, and then slowly tapers off. It's perfectly bandpassing the signal, filtering out both the immediate noise and the permanent drift.
All right, Section 3, the mathematical engine.
Okay, this chart perfectly illustrates the math in action using S&P 500 index futures from 1997 all the way to 2026. Let's break down all three panels closely. Panel A is showing the raw EWMA filter signals. You can clearly see that fast 30-day filter in blue just whipsawing aggressively, while the slow 250-day filter in red is much, much smoother. Now drop down to panel B. This shows how those raw signals translate into continuous portfolio weights targeting a 15% volatility. It's fascinating because you can see the weights hitting extreme spikes precisely during periods of exceptionally low market volatility. Finally, panel C shows the cumulative returns. The red line, the slow filter, absolutely crushes it here. Why? Because it captures the long-term positive drift of the S&P 500. Meanwhile, the fast blue filter actually loses money because it just gets completely chewed up by short-term noise.
So what is the math actually doing behind the scenes to generate those returns? Well, the expected return of this system essentially boils down to two key things. First, the square of the daily sample Sharpe ratio, which captures the directional drift of the market. And second, the sum of sample autocorrelations, what we call market memory. Basically, for a system to profit when a market is moving completely sideways with zero drift, that sum of sample autocorrelations at positive lags must be overwhelmingly positive.
Which leads us to a really beautiful, if maybe a little intimidating, mathematical conclusion using the Hergelot's theorem. When mapped into the frequency domain, the expected return is a Poisson kernel reading of the market spectrum. But to translate that out of heavy quant speak, alpha in trend following is simply excess spectral mass at low frequencies. Long filter spans specifically act as a finely tuned reading instrument to capture this low-frequency long-term memory of the market.
Let's move on to Section 4, stress testing the models.
First up, we test the system in a white noise environment. This means there is absolutely zero market memory. Prices are just a pure random walk. Check out Panel A and Panel B. When the drift is zero, those are the black dots, the Sharpe ratio is strictly zero across every single time span. The strategy literally can only make money if there is an inherent directional drift, which you can see with the blue and orange dots. And notice how the Sharpe ratio strictly grows as the span gets longer. But here's the kicker. Look at Panel C, which factors in real-world trading costs. Fast spans, like 1 week to 1 month, actually generate vastly negative net Sharpe ratios. The trading costs completely eat you alive when there's no short-term memory to exploit.
Now we change the game. We inject an AR1 process, meaning we add short-term memory. Look closely at Panel B. The blue dots represent a market that diverges, so positive short-term memory. Notice how a super-fast 1-week or 2-week filter monetizes this perfectly. It delivers massive Sharpe ratios. But as the span gets longer, pushing toward 1 or 2 years, that edge completely decays. On the other side, if the market mean reverts, the orange dots, the system hemorrhages money. And again, Panel C is our ultimate reality check. Once we slap on a 20 basis point trading cost, that massive short-term Sharpe ratio just plummets. It reveals this razor-thin knife edge, where costs completely dictate the viability of hunting short-term alpha.
Finally, we test the RFEMA process. This is the ultimate stress test because it models deep, fractional long-term memory. Let's really dig into Panel C here. Even if the market has aggressive short-term mean reversion, which you can see with the orange dots starting way below zero at the 1-week span, the net Sharpe ratio actually turns positive and stays highly profitable just as soon as your filter span exceeds 1 month. Notice that distinct hump shape of the black dots in Panel C? That perfectly illustrates the delicate balance of algorithm design. You have to find that exact interior span, usually around 1 to 3 months, where the alpha from long-term memory perfectly outpaces the drag of trading costs.
Which brings us to Section 5, real-world market application.
So, to validate all this theoretical math, the explainer uses a massive dataset of 84 highly liquid futures contracts across every major asset class: equities, bonds, FX, energy, metals, and agriculture. The backtest runs from 1997 all the way through mid-2026. We aren't just looking at idealized returns in a vacuum here. We are applying brutal, real-world transaction friction to every single trade.
And speaking of friction, this table is absolutely essential to understand. Theoretical math has to survive practical transaction costs, right? Look at how drastically costs have evolved over time. Prior to 1992, trading commodities cost a massive 58 basis points per trade. Today, that's plummeted to around 10 basis points. Equities dropped from 34 down to just 6 basis points. This completely explains why fast-moving short spans were basically impossible to trade profitably decades ago. The transaction costs would instantly nuke your gross Sharpe ratio. It was only as markets modernized and got cheaper to trade that shorter span, high-turnover trend systems actually became mathematically viable.
And here is the incredible plot twist in the data. We started this whole thing by defining 3 distinct philosophies: the continuous European math, the discrete American breakouts, and time series momentum. But the backtests reveal that when their parameters and spans are properly aligned, they perform virtually identically. In fact, they all show an 80% correlation with the SG Trend Index benchmark. Despite incredibly different mathematical routing, they are all successfully hunting the exact same underlying market alpha. Which leaves us with a really fascinating question to ponder. We've proven that trend following isn't just magic, it's the strict mathematical extraction of excess spectral mass at low frequencies balanced tightly against the realities of trading costs. So, as markets continue to evolve and friction approaches zero, how will this delicate balance between filtering out noise and capturing long-term memory dictate the next generation of algorithmic design? Thank you for exploring the deep science of trend following with us today. Keep learning and always keep questioning the math behind the markets.